Business ownership is the best way to build wealth, and buying a business is the fastest way to get there. If you're looking to buy a business, you really got to dig deep into personal expenses that the previous owner is running through the business. Now, these are called addbacks because they're just expenses that you're adding back when calculating the owner's benefit or the cash flow, or what others would call the seller's discretionary earnings, or SDE. And basically that's just the amount of cash that's going to accrue to you as the new owner. And an example would be a business paying for a car for the owner that really there's no reason for this business to need a car. So these are just expenses that the business owner is running through the business. They're not actually expenses for the business. So now the problem with purchasing a business with a lot of add backs and a lot of personal expenses run through is going to be during the loan process. So the banks are going to be very strict about what they allow you to add back to calculate the cash flow. So what can happen is if you have a business where the seller was running an excessive amount of expenses through the business, it's going to be a lot harder to get financing for that business. So to give you an example, we bought one business that when we go through our numbers, we believe they make $300,000 per year in cash flow to us as the investors. But according to the bank, they only make $100,000 because the bank's not going to give us credit for all of the add backs. He spent about $60,000 at Costco. He had an apartment. He had a car, just lots of expenses running through, and the bank wasn't going to give us all of them. So that meant we could only get about a $500,000 loan, which is a problem because in this instance, the seller wanted $900,000 for the business. Luckily for us, in this instance, we were able to structure the missing $400,000 as a seller's note, but that seller's note has to stay on standby for 5 years, meaning we're not allowed to make interest or principal payments on that note for the first 5 years. Now, this structure was so that our debt service coverage ratios with the bank could line up to the lower cash flow number that they had calculated because they didn't give us credit for the add backs. So for us, it worked out. As a buyer, it's actually going to be a better deal for us. But as a seller, he could have had $900,000 up front if he hadn't been so egregious about the expenses he'd been running through the business. So always be mindful as a buyer that businesses with lots of add backs can be more difficult to get financing. If you're a business owner looking to sell at some point, stop running stuff through your business a couple years before you're ready to sell. And that way it'll look much better to the bank. And that means buyers will end up paying you more for that business because they can get bigger loans for it. So reach out if you want to partner with us to purchase a business, or if you're a business owner that's considering selling, reach out and we'll help you get things ready to sell.